Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. If we go back a couple of years ago, Exxon Mobil had actually been one of the worst investments in the S&P 500 over the prior decade. But I can tell you a lot has changed and it has turned into an absolute cash cow. But there's a secret reason why this oil giant is primed to continue to deliver supercharged returns for its shareholders going forward. I'm Jason Hall. This is The Smattering. I've got Tyler Crow here to talk with me about ExxonMobil, which I know is one of his favorite of the super majors in the oil and gas space. Hey, Tyler.
How are you doing today? Oil and gas, always a great topic.
We've been talking about it together for over
a misunderstood topic.
It is misunderstood. And, you and I know that. We've spent more than a decade writing, researching, and talking about the oil and gas industry together. But let's talk about ExxonMobil, right? So we go back to the prior time there was $100 oil, kind of peaked, I think, in 2014. Then prices crashed. I think it fell. Oil lost $70 or $80 a barrel in price over the next year or so, year and a half, before it finally bottomed and slowly crawled its way back forward until crashing again in the coronavirus pandemic. And of course, over that period, you had this massive exuberance starting in like 2011, 2012, washed out so much returns for investors. The industry got really challenging. ExxonMobil was really profitable during most of that period, but was a terrible investment because of the economics of the oil and gas market. And frankly, some missteps management made. Tell me what's changed, what's interesting to you about ExxonMobil right now, and why you think investors should be looking at it.
We can call the 2010s and the 6 to 8 months after the initial into 2020, kind of with the pandemic, kind of the lost decade for oil and gas. Yeah, I'm actually looking at it right now from basically January of 2010 to May 31st, 2020. ExxonMobil on a total return actually lost 1%. It was just an awful time for them. And we talked.
And the opportunity cost, comparing that to the broader market, you missed out on
237% gain for the S&P 500.
Right. More than tripling your money just buying an S&P index fund.
So you mentioned the crash in prices in 2014, but there was a little bit more than that, because when it comes to oil and gas, it's not just the price at which you sell, but how much it costs to actually happen. And from 2010 to 2014 was an awful time for the oil and gas industry, in the sense that they were a very bloated business. They had spent much of 2005 through 2012 chasing a lot of oil under what we all kind of remember as the peak oil thesis. Oh, we have reached the total amount of oil that we're ever going to find, and it's going to kind of all our reserve declines are kind of from here on out. Everybody got
the consensus had become, to a certain extent, that we were going to enter a long period of persistently high crude oil prices.
And what ended up happening is it ended up fostering the shale revolution in the United States and a couple other places, but mostly the U.S. The U.S. has basically increased its oil production almost by 10 million barrels per day from 2005 to, I believe, today. It's a monumental swing in American production and global production, because of it went from a declining asset base to one of the fastest growing globally. So what ended up happening with that, the only thing that made that possible, though, shale early, was that high price, because the service costs associated with it were so high, trying to figure out, well, how do we get this out of the ground? How do we do it well? If you go back to that time, you'll look at ExxonMobil and a lot of others, and they would say their break-even price was $75, $80 a barrel, because that's how expensive things were. 2014 happened, and all of a sudden we all looked around and said, holy crap, we've brought on all this new production, and it's expensive. And oil prices were falling because demand wasn't growing that fast. And they spent 2015, pretty much up until post-pandemic, sweating their assets, getting lean, selling off unprofitable assets, becoming much more a leaner operation, cutting where they can, more vigorous underwriting of their new production, new facilities, new assets, and it's just made them much, much better. ExxonMobil and also I believe Chevron now say that they can pretty much do what they do, maintain production, pay their dividend, which to them is part of their return basis, and say we can do that at $40 a barrel. It's a monumental change over the past 7 years, and why it looks like, even though we've seen an oil crash, from above 100, right? last year, you're right around the time of the initial invasion in Ukraine to today, we're back down into the $70 to $80 range. Despite that, these companies are still massively profitable and probably likely are going to continue to do so because they are such leaner operations than they were in previous years.
But that's only part of the secret here. I think the other part that's important to talk about is what they're doing with all of that cash, because again, making a ton of money back in 2012, 2013, 2014, spending it poorly. What's the other part of the secret now with what they're doing with their cash flows today?
Well, now that they're making a lot more of it because they're more profitable industries, they're being much more disciplined in their spending. Despite the increase in production or the increase in prices as of late, ExxonMobil is projecting a budget that is considerably lower than it was in 2010, 2014. I think they want to keep it between 20 and $25 billion annually. And as a result, they are saying, look, if we think we can continue to do what we do with this, maybe grow our production modestly, and we're going to use that and we're going to buy back stock and we're going to pay dividends. Again, that's the core value proposition when we're talking about these businesses, because, at 3.7 million barrels of oil per day at ExxonMobil, you're not going to grow. You're not going to move the needle huge there. So the big value proposition is being able to extract per share value. And with I believe it's a $50 billion share repurchase authorization recently, on top of the dividend that's been there for more than 30 years at least, there's quite a bit going on behind the scenes that is going to create value for investors that doesn't necessarily tie with, share price or oil prices.